much for tuning into Talking Point. I'm your host, Neeraj Shah. A bunch of things that the market might have at the top of its mind. Clearly, it's shown that the Karnataka election verdict has not had a bearing relative to the expectations that the markets would have had about the election outcome. But there is the US debt ceiling to talk about. Geopolitics, of course, continues to be center stage. And now that the earnings season has passed, what else does the market look forward to? Let's get in somebody who invests large oodles of investor money into his set of mutual fund schemes. Taher Badshah of Invesco joins in right now with his thoughts. Taher, great having you. Thank you so much for taking the time out and being with us.
Pleasure is mine, Neeraj. Good to see you as well.
Yep, thank you. Taher, so what's the landscape according to you? We've had a state election verdict, which the market in his wisdom may have thought might have an impact. For now, no movement either direction, which is not a bad sign, but there is global things at play which might be on top of the market's mind. What is it that you're looking at?
So I think Neeraj, we started off the calendar year essentially somewhat cautious and worried on two fronts. One was that India on a relative valuation scale because of its significant outperformance during calendar year 22 was perched right up there. I mean, our premiums to global markets, as you know, had reached all-time highs. In any case, India trades at a premium most of the time, and this was even beyond its regular long-term premiums. So it was something which was somewhat of a headwind for us to begin with. Plus, the other thing that we were worried about was essentially some signals and anecdotal evidences that we were picking up more than the high frequency, alongside with the high frequency data, that things were kind of slowing down in India, particularly as a combination of one base effect, because last year we had done exceedingly well as an economy coming out of COVID, etc. And then secondly, we started to see some impact at the margin on account of higher interest rates, which came into the system during most part of 22. So I think those were the two, problems or the concerns that we were running with. Now, as we've probably had that actually coming in the way, and therefore the markets have found it difficult to actually move up very meaningfully. We've had it go down and then come up a bit over the last few weeks, but by and large, it has been a somewhat range-bound market. Now, since then, of course, in the last 4 or 5 months, one part of it is actually kind of one of our problems or one of our concerns is actually kind of, somewhat mitigated. So from a valuation standpoint, India on a relative scale, more importantly, has actually become reasonable now compared to many other global markets. Combination of both India actually not having done as well and, kind of having time corrected. And second being that some of the global markets have actually done relatively better. So India has underperformed in the last 6 months, particularly with respect to some of the developed markets. So those premiums have actually come down to more reasonable levels. So that's something which is kind of, gone out of the equation at the moment. And alongside which, a few weeks ago, we also saw RBI actually being one of the first central banks around the world to actually move into a pause. Now, that's that also at one level, to my mind, actually takes away the valuation risk, because obviously the multiples in the market were coming off due to interest rates constantly rising. And now that interest rates are not likely to rise anymore, there's no reason for premiums to actually, valuations to actually further erode. So I think the valuation risk of the market in India too has actually been taken out. We are still contending with the growth-related matter in the market and the economy, and signals in that regard are somewhat still tentative. However, we've been kind of happy to see the way the overall result season seems to have progressed for the March quarter up until now. So I would like to think that we are in a state of diminishing, concerns or diminishing headwinds as far as the market is concerned.
Interesting. So, Taher, the one of the points cited by multiple people around why the markets could be volatile, aside of all the factors, was that we are heading into May 2024. There are 5 state elections, so therefore there is it's a recipe for volatility. My question to you is, the markets having behaved in the run-up to the Karnataka verdict and early this morning, maybe too early to say, but from whatever little we have this morning, seems to suggest that state election verdict, one way or the other, may not be as much of a market mover. Would that be an assumption safe to make currently, or is it too early to call that?
Well, I'm not very good at politics, but I'll still take a call. And uh, my sense is that I mean, there are Karnataka has been much talked about in the last some time, and there have been opinion polls and all those kind of things which have been going around. So I don't really think it is. I mean, the final outcome has been probably a little more stronger towards the winning party, but. In general,
Not
it seems to
surprised.
be have been in line with whatever the expectations were.
Right.
So I think it is not. It's still not conclusive, but it is obviously something which will become a point to watch as we get into more and more of the election results. There are many more to go during the course of the years, So it's incrementally. I think it will, the story will evolve in my view, and we are budgeting for this in the sense that we know that to that extent, while I said that the bottom of the market more or less seems to have been established, but we don't really see the possibility of market getting into big highs
Got
into
it.
2023. It might take a little bit of time in 24, and not just because of politics, but I think more because the earnings cycle will start turning more in 2024.
Okay. Okay. And just before I probe that point, just one more small macro, Taher, if you will. How concerned are you for the Indian market watcher about this whole US debt ceiling? I mean, one would believe that at some point of time they'll reach a resolution. But as a Nomura note this morning was suggesting that, a lot of volatility happens back in 2011 too. They had cited that instance. Are you thinking about it a lot or not really?
Well, not really. I think I mean, we've seen this, uh, you know, unfold in earlier years as well, and somehow, they have their own politics around it, and they don't. They eventually get through it, and but the thing is that obviously from a fiscal standpoint, they continue to remain in a stretch position. But I think the bigger debate after, as soon as this thing will probably be over within a few weeks, I'm sure, and I think that we will still move on to the more important debate about how is the extent of the slowdown out there, and is it as deep now or not? I mean, even there too, we would like to think that the market's mood is now shifted from assessing as to when interest rates will peak, because that is now more or less given, and it's more or less been established that interest rates are probably not going to rise year on. It is now just to see that the extent of the interest rate hikes which have happened, what is the kind of drag that it brings onto the economy. So initial thoughts of the market are veering towards the side that, look, have we done too much, and is it therefore going to slow down things dramatically? And I think that is the reason why, that is where the market's next level of concern and the next level of debate in the market will be.
Are you concerned? Are you cautious at the current levels? Because I heard you say it's a range-bound market.
Yeah, so basically, I think as of now, in the base case, it is obviously that US will we are looking at a scenario where most economies around the world will slow down compared to 2022, including India as well. And that probably is not even a surprise, maybe, except for China, which probably because of its COVID calendar is going to be a little different and probably grow. But most other markets are likely to be slow mode. Within which I think the US labor markets are also now softening, and interest rates and inflation in any case is starting to kind of become a lot more reasonable. So I would like to think that the pressures on the economy will not be as acute, and I would like to believe that as of now it is still going to be a soft landing mode, but the markets will readjust to the possibility of somewhat slower growth in the US, and alongside which India too is, as I said, I mean, we had started to see signs of India moderating a bit 6 months back, and that's clearly happening. 250 basis points interest rate hikes in India too is not a small thing. It's starting to seep in, particularly for the consumption part of the economy. So I think that's so we are building in relatively more conservative numbers, so to speak, in terms of earnings for corporates at the Nifty level or whatever else.
And then therefore, what is your overall portfolio positioning? Part one of my question is that, Taher. Part two is incrementally from where we are right now until the end of the year, because of the peaking of rate argument, or the fact that this verdict has led people to believe that will the central government now turn more populist in a bid to appease the rural and the farmer community in a meaningful way for the other elections, so on and so forth. So what is the current portfolio positioning? Do you reckon you will make some incremental changes to that positioning by virtue of what's happened in the last 1 month?
Maybe a bit. So we have been on this line of thought in the last I would say 3-4 quarters now, perhaps a little more, but got even more strengthened in the last 2 or 3 quarters. That based on what we were seeing, essentially, that the industrial part of the economy, the investment-led part of the economy, was behaving a lot more strongly compared to the consumption part of the economy, and therefore many of our portfolios up until now and even probably today are relatively more positioned towards the industrial cycle, including things like banks, industrials, and industrials. We have a fair variety. It's light engineering, defense, and road construction, and the work. So there's a fair bit of all that. And I think that's played out quite okay, because that is where we could see a strength and consumption clearly because of the interest rate hike being affected immediately. So I think now with, like as I called out, that that we are seeing that possibility a little more clearly, that interest rate hikes are going to be in a pause mode for now. Probability wise, Neeraj, I mean, we're quite, I don't think there's much to debate. There's that the next move of interest rates, maybe in India as well as globally, has to be down. It can't be up unless inflation surges once again from here. And as of now, we don't see any reason for that happening. So I think if interest rates are likely to go down, maybe not in 23, but eventually the cycle might turn in 24. To us, it appears that there needs to now then be a shift towards some of these consumption stories. They've underperformed as well. They obviously are bigger beneficiaries if at all rates start to kind of ease up a bit. And on the other hand, the industrial pack of the market has done exceedingly well, hitting new highs and significant outperformance. So at the margin, we are somewhat inclined to take some money off the table from there and put it on the other side to make it work.
Okay. So just last 2 questions, Taher, before we leave you on this capex theme, right? Within that there are buckets of companies which are trading at extremely high valuations, though relative to their histories they might still be okay, and then there are some which are a bit more moderate. Are you taking money off the higher valued stocks necessarily, or are you basing it on the growth targets given by these companies, and therefore the ones with the lower growth potential are the ones where you are maybe inclined to take it off? Just trying to understand how are you viewing that bucket.
So broadly, at one level, Neeraj, the whole table has gone up
Right.
for almost everybody. But yeah, I mean, we don't have a choice. We will move, piece by piece and strokes for different folks. So there will be some companies which are well ahead of their own historic valuations as well, and that's where we have started to see in certain pockets. And then there are certain others who are also up out there, but still not all the way up, and maybe they merit a little more. So we'll be a little choosy. We'll have to differentiate. So we're not necessarily suggesting that is a pack that we have to now completely desert, but it obviously has played out somewhat more strongly than we own that compared to our own expectations in the very short term. So it probably makes sense. And not just that, but like as I said, on the other side, there are some of these other things which have actually kind of come off or have underperformed and are offering some kind of value. So I think we're differentiating it like this. That look, those are growth pockets and these are value pockets. So in our value strategies, we're happy to represent some of those value opportunities, and in the growth pockets, we continue to be there. I still think that the industrial cycle is very solid, and at least from an macroeconomic standpoint. But from a market standpoint, it always happens that market starts doing funny things in a very short period of time. So we as active managers, we need to probably take some cognizance of that. So that's how we are essentially up to.
So well put. Well, it's a good thing, Taher, if things do actually better than what you anticipate. I mean, why would one complain for that? So I'm glad, happy for you. One last question, Taher. The discretionary stroke reopening part in India, they've done really well. I mean, select pockets, hotels in particular, but maybe QSRs and a few others. Maybe not the multiplexes, but then you don't have too many plays there. My question though really is, their guidance or their commentary at the end of Q4, especially hotels, was very strong. But aviation too has some tailwinds here and there. The airport traffic is looking extremely buoyant even for April. How are you approaching these? Because, I mean, they have rallied quite strongly, but the commentary is rock solid.
Yes, so I think some of these, particularly, those which are related to the travel and tourism industry and ancillaries, at one level, within our lingo, as in our scheme of things, in our investment framework, we actually look at them more like cyclicals.
Okay.
And they've behaved as such in the past. So For example, hotels is a cyclical business at one level, or even if you wish, a commodity business. Because the thing is that they go through these cycles where they do very well when capacities have not come up and there's underinvestment, and obviously rates go up and they make a lot of money. And then the reverse happens, that as you start making a lot of money, then eventually capacities start to come in and your project announcements will come in. So so we treat them as cyclicals, and I would like to think that some of these are at, well, I mean, they're clearly not below mid-cycle. I mean, they are somewhat above mid-cycle, if not all the way up there. So I think we've been happy to get in a little early in some of these things. We are happy to ride it still more, a little bit more. And I think as of now, we're not seeing that very large surge in capacity. But then you can't even have a situation where prices are taken to somewhat extremes, because then it can be a backlash in terms of destruction of demand. So I think it's still a reasonably decent story. Probably valuations and all that have gone up. They, like as I said, they are no longer early cycle. They are more mid to somewhat above mid cycle at this stage.
Got it. Taher, the next time that we talk, maybe in 3 months' time or otherwise, we'll try and talk about where is it that you see early cycle opportunities, because we'd love to do that with you then.
Absolutely.
Great. Thank you. Thank you for taking the time out and being with us today, Taher.
Pleasure again. Thanks.
And viewers, thanks for tuning into this edition of The Talking Point. Much appreciate. Thank you so much. Okay.